In today's video, I will be revealing the three distinct levels of retirement investing that most Canadians fall into, although few realize that these levels even exist or understand which one of they're currently operating at. Through analyzing hundreds of Canadian retirement portfolios, we have discovered that most retirees believe investment approaches are simply either safe or risky, completely missing the strategic framework that could dramatically improve their retirement outcomes. That's exactly why we're making the video today, to show you the three critical levels of Canadian retirement investing, help you identify which level you're currently at, and reveal how moving up these levels could transform your retirement security and legacy potential. Let's get right into it. Level 1, the preservation mindset that focuses on safety. Many Canadian retirees like to invest in guaranteed investments or guaranteed securities, things like GICs, savings account, or government bonds. And even though all of these are guaranteed at a certain level, GICs are guaranteed by our institution. And if your institution was to fail, up to $100,000 per institution would be guaranteed by the government. Savings accounts very similar, and government bonds are guaranteed by the government of Canada. The trade-off is that interest is the most expensive form of income you can receive. So interest is fully taxable in an unregistered account. Liquidity, meaning how easy is it to sell an investment or to get out of an investment. Well, with a GIC, as you know, if you want to receive a decent interest rate in a GIC, you have to lock in for 1, 3, or 5 years. So GICs are not very liquid. The other thing to consider is inflation. And during times of low interest, which we have been in a long time, inflation will essentially erode your capital over time. So the bottom line is that even though many Canadians like to invest in GICs and guaranteed investments because your capital is protected, in a low interest rate environment, these strategies have not been very effective. Level number 2 is the traditional portfolio approach. Traditional portfolio is a combination of stocks and bonds, and whether you invested in ETFs, mutual funds, or these individual securities, those all would be considered traditional portfolio. If you're investing with your local bank, 9 times out of 10, you are in mutual funds. And think of a mutual fund as a basket of various securities, and 9 times out of 10, you would be in a balanced mutual fund. So in a balanced mutual funds, basically half your portfolio would be stocks, and half of the portfolio would be government bonds and corporate bonds, so fixed income. This approach, the traditional portfolio approach, will create wealth over the long term and will definitely outperform level 1, just investing in GICs and savings. The trade-off is that obviously you're invested in the market, so you're taking on market risk. And also, when you're investing in mutual funds, most of these mutual funds have some sort of a product fee built in, and these fees could be fairly expensive. The other trade-off for the traditional portfolio approach is that the traditional 60-40 portfolio, the balanced portfolio, has not been as effective over the last 2 decades for the reasons I have mentioned early when I was talking about level 1. And the reason for that is since interest rates have been low since 2008, 2009, for almost 2 decades, half of your portfolio in the traditional portfolio approach has not been as effective as it could have been. The traditional portfolio approach provides sustainable lifestyle funding, but level 3, institutional style investing, creates multi-generational opportunities. So level 3 is institutional style investing. And what we mean by that is investing in a similar way to what large institutions like CPP, Canada Pension Plan, Harvard and Yale in the US, Ontario Teachers Plans, and so on, investing like these large institutions. And I did mention already the financial crisis of 08-09 in this video a couple of times. But if you recall, back then, after the market correction and market pullback in 08-09, market value of CPP, because stock market went down by almost 40%, CPP did not have enough assets to fund their future obligations. So not only CPP, but all the other major players have been diversifying away from the stock market and away from the bond market into things like infrastructure, private real estate, private credit, private equity, to make sure that when a future crisis happens, that portfolio will be much better protected. CPP, Harvard, Yale, all of these other institutions are trying to do exactly the same thing you're trying to do with your own portfolio, your own RSP, with your own RIF, which is to minimize risk and optimize your returns or maximize your returns. So level 3 approach is a combination of all the benefits of level 1 and level 2. Because if you think about it, when you're including private real estate, when you're including private credit, when you're including private equity in your portfolio, all of these asset classes are not correlated to the stock market, meaning they do not move in the same direction at the same time as the stock market does. So when the stock market is not doing well, when the stock market is tanking, private real estate, private credit will actually protect your portfolio during those events. So level 3 is independent of the market. Level 3 provides most favorable taxation. It has better liquidity than level 1. Level 3 investing is also inflation protected. And ultimately, you would be receiving equity-like returns with level 1-like safety. So ultimate goal is to provide highest returns possible. Now that you understand how these investment levels work for Canadians, let's determine which level is right for you for your own retirement. Well, first of all, you need to assess your essential expense coverage through guaranteed income like CPP, OAS, or private pensions. Then you need to calculate your risk capacity based on portfolio size relative to withdrawal needs. You need to determine your psychological comfort with different levels of market volatility. Then you need to evaluate your legacy goals and desire to transfer wealth to future generations. And you will create flexibility to move between these levels as your retirement situation evolves. If you want help determining which retirement investment level is optimal for your own specific situation, click the link in the description below to get personalized Loom video where I will analyze your own situation and show you exactly how to implement the right strategy for your own retirement. I'll see you in the next video.